special or fashionable. Fog scent. New fashion wear for men.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then. Investment advisor Sharmila Joshi, G. Chokkalingam of Equinomics Research and Senthil Manikandan of Newberry Capital join us on the show. Today on Hot Money, we'll discuss stocks like Ashok Leyland, ICICI Bank, Max Financial and Sintex Industry. So these are the stocks that we will be covering on Hot Money today. Let's move on to the first stock, and the question that and the stock is Ashok Leyland. Stock pretty much trading at fresh record highs. The big question that we're asking our guests at this point of time is that will the rally in Ashok Leyland continue? That's the big question that we're asking. So Chokkalingam, you have a minute on. So
yeah.
Will the rally continue in Ashok Leyland, and if yes, why?
Not the way it has rallied.
Okay.
Certainly, you know, it can move along with the market because the stock has in 3 months given 27% return. From 52-week bottom, it has given almost 100% return. And also, if you look at the PE, it is trading at around a 22-23 PE on 1 year forward earning. And in relative terms, when you have seen so much of crash in the mid and small cap stock in this market, I believe there are many other better ideas to invest and make more money than in Ashok Leyland at current price.
Okay, so that's the view that's coming in from Chokkalingam. Senthil, your opening statement on will the rally continue for Ashok Leyland?
Same like what Chokkalingam mentioned, the rally may not be that much fast from here on, but government policy is coming in. Like currently the government is already tightening their overloading of trucks ban, so they are very much vigilant in these areas. Plus there is news going on like the scrappage policy for vehicles which are older than 15 years is going to come in, and there is a lot of incentives which are going to offer to the fleet owners who are going to scrap the older vehicles. So if this comes, the management is of the view like there are around 1 million trucks flying which are around more than 15 years of age. So this is around 3 to 4 times the annual truck market. So this is going to be major demand driver for the next 2 to 3 years. So I think the CV cycle is going to be much better in the next 2 to 3 years, and Ashok Leyland is a much better play compared to Tata Motors in this.
Okay, and Sharmila, one of Chokkalingam does believe that it will rally but not so much. So similar cases here, would you believe that? What's your opening statement on Ashok Leyland?
Well, I think the rally will continue, and I think I mean pace of the rally I can't really comment, but I really think that the rally will continue. To just take off from A is of course this vehicle scrappage policy that we are hearing about, that has obviously sort of added buzz. And I think more importantly, why I think that Ashok Leyland will the rally will continue is the fact that it has joined the rally late. So you had all the auto stocks rally all of last year, and Ashok Leyland spent forever at that 110, 115 level. It never went above that. And strangely enough, when the entire market is correcting, we have Ashok Leyland going up. So it is under-owned. So just from a technical perspective, I don't think the valuations are too high. So I think it can easily go to like a 155, 160 level before it really significantly stops and corrects. So my sense is at least till then you're sort of comfortable in a bad market. You need some stocks that do well and add little pep to your portfolio. So I think Ashok Leyland could well be that stock. Okay, so that's the consensus view that we're getting. Probably no one's bearish on Ashok Leyland at this point of time. So we'll open up the show, the segment for discussion. So Chokkalingam, we were talking about there are better opportunities than Ashok Leyland. So which are the companies which could provide a better in this space, provide a better investment opportunity for investors?
In this space, I am not confident that one can make a big money. But if the intention is to make money, then I would something like Andhra Sugar. The name is misnomer. It's a sugar. Actually, it is into caustic soda industrial chemical. They account for more than 95% of the total profit. The stock is down about 35 to 40% from the peak, and trading at 8-9 PE, and excellent dividend and excellent balance sheet. And it has expanded the capacity of caustic soda. It has expanded the capacity of aspirin. And despite 20 crore loss from sugar segment, it is expected to post around 40-45 EPS now. Now, definitely the sugar segment will start at least breaking even, if not, making some significant profit next financial year. So I am estimating somewhere around 60 EPS for FY19 for the company.
But nothing in the CV space. Are you overall not bullish on the CV space at this point of time?
This is the only company which is doing well.
Okay.
Ashok
What
Leyland,
about Tata Motors? Because if you're looking at valuation, that's one of the cheapest stocks.
Yeah, but
would you not like a Tata Motors?
Yeah, because the domestic business is not more than 50% of the total business. So what is driving it is the GLR and all, and there is a lot of uncertainty, and particularly from Chinese market, where GLR accounts for 1/3 of the sales. So I have my own fear on the margin, coming from the Chinese market of JLR.
Okay.
So therefore, I would prefer something like sector diagnostic, stock specific in the mid cap space where we can make a lot of money.
Okay, and Senthil, your view on what would be a better choice if someone wants to put in. One time you have Ashok Leyland trading at record highs, and you have Tata Motors trading at a 52-week low. Risk reward, where is it better now?
So Tata Motors, their domestic business has started to perform well, but at the time what has happened is their JLR franchise is not doing well. So JLR, there are a lot of headwinds coming over in JLR because we have seen Brexit, and then now what you are saying is like the US putting out tariff and the trade war starting. Actually, the JLR is majorly focused on the export market. So they have manufacturing facilities in UK and now they are starting in Europe, but their major export market is UK, China. So with all these trade wars and news and talking about, I think Tata Motors, 90% of the value is from JLR. So with JLR weakening, I think there is not much reward from the Tata Motors, even though the stock is looking cheap.
Okay. And Sharmila, same question. Do you think that since you said that another 15-20 rupee upside is possible since Ashok Leyland was a late mover, is it time for someone who's holding to switch to Tata Motors or any other four-wheeler or any other auto stock?
I would agree. I think that's a good strategy. I think Tata Motors makes sense to me at this price. I completely agree with the JLR piece, but I think that their domestic business will do increasingly better. I like Mahindra and Mahindra at this price. I think their farm business, that side of the business has done well. That at this valuation to me looks okay. Escorts again has run up a lot, but I think there too they have just like Ashok Leyland, where you hear of new products coming in every 6 months and getting into different segments. I think Escorts is also on that kind of a track. But in terms of valuations, I would say to me Mahindra and Tata Motors.
Okay, so that's the view that we are getting in on Ashok Leyland. Two of our guests do believe that the rally will continue going ahead. Chokkalingam does not believe that the rally can continue. He's saying move on to something in a different sector only, especially he spoke about Andhra Sugars at this point of time because valuations for Ashok Leyland look expensive. The other stock that we want to talk about is also in the limelight, and that is ICICI Bank. Banks have had a very terrible run of late. Among the private sector banks, ICICI has been down almost 20% from the recent highs. So the big question that we are asking is it the right time to start accumulating ICICI Bank, or is there more downside? So Sharmila, your opening statement, is the right time to buy ICICI?
Well, the stock corrected with the rest of the banking space, and lately the last fall came with this whole SFIO incidents with both the MDs of ICICI Bank and Axis Bank being called for questioning. So I think once that clarification has come, a little bit of the pressure is off that stock, as can be seen in the last couple of days. But I would say don't. I would say don't accumulate. For two reasons. A, I haven't really liked the Q3 earnings for ICICI Bank much, and off late you do get a sense that there is some amount of pressure building up in terms of NPAs, etc. And among the older private banks, possibly ICICI Bank is not, I would say, as bad as Axis Bank, but it is not had the best run with NPAs. And secondly, I think overall banking as a space is going to continue to see pressure. So you can hold what you have. I don't see a concern with that, but I wouldn't accumulate more at this price.
Okay, so that's the opening statement. Your opening statement, is it a good time to start accumulating ICICI Bank?
I think yes, because if you look at the ICICI Bank as a franchisee, they have a retail business which contributes around 54% of their total book. Plus, they have a lot of joint ventures in the life insurance business, general insurance business, and they have a capital market lines of business also. So if you just put together a SOTP valuation of the entire ICICI Bank as a franchisee, their core banking business could be around 200 rupees of value. So that on a adjusted book value of around 135 rupees, it is trading at around 1.3 times or 1.4 times. And as per the management commentary on the con call, they said like going forward, I think the slippages will be much less compared to the last 2 years. And even in the second NCLT case, actually 98% of their exposure has already been in the NPA. So they have given a provision of around 36% for these loans. So going forward, I think the slippage is going to be much less compared to the last 1 year. So we are much positive from here on.
Okay, so and is it the right time to start accumulating? You have a minute for your...
No, certainly one can accumulate. I'm not overly bullish. You are not going to create a mega wealth in ICICI Bank. But if you look at post-Lehman crisis or post-2010, all these banks, including ICICI, have been hammered and then come back to the normal growth path. Why I'm saying this is that historically, the banking industry has been a perennially growth story. We never had a continuous degrowth in the banking sector. So the perception is now against the sector. But I'm pretty sure that they all will come out. NPA is speaking out for the industry as a whole because most of these NPAs are inherited one and they are picking out. And particularly ICICI Bank has got so many JVs and subsidiaries. And we saw recently the insurance firm, how they unlock the money. So there is a lot of potential to unlock money from home finance, security business, asset management. And the stock also corrected a lot. So I'm pretty sure from this level it can definitely give anywhere from 10 to 20%.
Okay, so that's the view that's coming in on ICICI Bank. Sharmila says that it's not the right time to start accumulating, but other guests do believe that you should start accumulating. So I'll start with you, Sharmila. What seems to be the big problem in ICICI, because valuations are pretty much at lows. It's almost near a PSU bank valuation. When HDFCs and all trade at 4 to 5 times, it's trading at almost 1.2 to 1.3 times. So is valuation a concern for you, or is this NPA a concern for you, or what is the concern?
I think banking is a concern for me, because I do agree in terms of valuation, it's looking attractive and it will give a return even from this price. My only, the only thing I'm trying to say is that don't be in a hurry to accumulate, because I don't, it's early days yet. We are still trying to get to the bottom of the whole PNB fraud. I was just reading the ticker saying that the banks are directed to ensure that this PNB type of fraud has not been done in other banks. So we are still, in that mode of trying to find out really the extent of the damage. And now we have seen the correction spread to the financial services as a whole. It's not only restricted to PSU banks, it has gone to private banks, it has gone to financial services. So I don't think we are done with this correction.
And it could hit the private banks also going later.
The fraud?
Yeah.
One hopes not, but they could be affected. And certainly I think as far as NCLT cases go, they do have names that figure on that list. Like for instance, every time you hear of an NCLT list, Axis Bank does always say that they have exposure to a lot of names there. So I don't think that we should be in a hurry to buy the stock. That is all.
Okay, Senthil, you said it's a good time. Are you extremely positive or you're mildly positive on ICICI Bank? And if you're positive, what's the reason you're positive?
So not extremely bullish on the stock, because the stock can give a index returns kind of 14-15% kind of returns. But my thesis is they have a core banking franchisee, and within the banking franchisee around 54% is from the retail. So they have a corporate loan book exposure of 27%. So this is the core banking. Second, what are the other assets they have? They have 55%, 56% holding in the life insurance and general insurance. Plus they have a AMC business and they have a broking business and home finance business. So put together these businesses alone could be valued at around a per share value of around 90 to 100 rupees. So core banking business is valued at around 200 rupees per share. So that even if you take into account the gross NPA is at around 7.8% plus net NPA at around 4.5%. I think going forward with this, I think the NPAs are peaked at this level. So we can value the bank at around having a good retail franchisee could be around price to book at 2 times. So I think going forward we can expect 15% kind of returns from ICICI.
Okay, and are you concerned about the asset quality of ICICI Bank? If someone is looking to bet on the private banking space because of valuation, should they bet on an ICICI, or they should shift to someone who doesn't have a problem like a Kotak or an IndusInd? No doubt when the valuations, or HDFC Bank with the valuations are much higher.
Yeah, interesting question. See, the NPA even for ICICI Bank has peaked out. Historically, if you see last 20 years, the NPA percentage used to be close to HDFC Bank. They all had a similar rate NPA. Now it has worsened for ICICI Bank. But if somebody has to make money and look at the larger set of banking sector, I would give 2 options. If you are very conservative, go back to HDFC Bank. I am sure they will mobilize, what they intend to mobilize from the market and scale up the business. And I'm also pretty confident that HDFC Bank will grow its net profit 15 to 18% for at least next 2 to 5 years. I have no doubt about it. So it is the safest banking stock. But if somebody is looking for alpha wealth creation, one can look at, in old private sector banks, like a South Indian Bank. It is trading at 1.2 times. Okay. And surprisingly, some of these old private sector banks, net NPA percentage is less than what ICICI Bank, Axis Bank have.
Okay.
And they have survived in the system successfully for 80 to 100 years. And they have seen a lot of consolidation happening at anywhere from 2.5 times to 4.5 times price to book value. So one can definitely make a lot of wealth in 1 to 3 years in South Indian Bank. Without any risk, one can consistently grow the wealth in HDFC Bank. So these are the two options I would give.
Okay, so that's the view that's coming in on ICICI Bank. Sharmila doesn't believe it's the right time to start accumulating. Senthil does believe that, it will give you more of an index type of return. While Chokkalingam says that, if you want to stick to private banks, stick to an HDFC Bank, or if you want a high beta counter, look at South Indian Bank at this point of time. The next stock that we want to talk about is Max Financial. The stock is trading at a fresh 52-week low. It's dropping every day. Ever since, there have been a lot of concerns put on the counter ever since, the merger with HDFC didn't happen. And post that, there haven't been any big positive triggers on the counter. But surprisingly, out of the 13 analysts that, track the company, 12 of them have a buy recommendation on the counter with targets as high as 720 to 775. But we'll ask our guest, do they believe that there is more downside left, or should they start accumulating Max Financial? Senthil, the analyst community is positive. Are you on Max Financial?
Yes, because if you look at the entire life insurance market in India, actually the premium per capita is just around $40. This is compared to China, it's around $200, and developed economies, it runs into $3,000, $4,000. So basically, what you are saying is, if you look at the history of the developed markets, the life insurance market grows in a S-curve. So once the GDP crosses $3,000 per capita, I think the life insurance market grows twice or thrice the GDP growth rate. So I think India, with the next 5 to 7 years, we are expecting a GDP growth rate of around 7 to 8%, and we are looking at a $1 trillion to add to the economy. I think the life insurance market will grow at a higher rate. And if you look at the moat in the industry, is only established players will flourish. And those players who have a strong bank insurance partnership will flourish. That's the only weakness with respect to Max Financial, is they are not promoted by a banking or a financial conglomerate. So that's the weakness I see.
I'll come to you. Your time is up. Chokkalingam, what's your view on Max Financial? What's causing this problem, and is it the right time to start accumulating?
Oh, there are two sets of problems. Basically, it's a holding company. It holds only 68% stake. And if you look at all holding companies, even a stock like a Bombay Burma, it has got a 51% stake in Britannia, FMCG, which is consistently growing, and it has got a discount of nearly 70%. So if you look at all the holding companies, the average holding discount is around 45 to 50%. And where here you have a holding of only 68%. So if I give even 30% discount, the current prices are fairly valued. And again, coming to the insurance business, today you have about 25 insurance players. All of them have got a foreign counterpart, joint venture partner, which means all of them are either bringing money or already brought money to shore up the capital and intensify the competition. It is not like the banking sector we saw 10 years ago, 20 years ago. Now the insurance sector is different. It is not going to grow consistently in strong double digit. The competition is intense, and therefore I would not buy this stock. I mean, I agree that there is not much downside because it has already corrected, but one can look at somewhere else to make money.
Okay, that's the view. Sharmila, you don't have a view on HD Max Financial, but I'll come to you on the general sector as such. But are you bearish on the life insurance sector as such, or would you prefer, there are lots of listed life insurance companies that have come in now. Anything from that looks interesting, or this entire space looks dull to you?
See, ICICI Insurance and HDFC, they are a great company, but market is giving a huge valuation. They are trading at 4 to 5 times also book value, about 3 times embedded value. I would buy something like Indian Bank. It may be surprising. Instead of buying any insurance company, I'll buy Indian Bank, which is the best PSU bank today. If you look at the league table in terms of net NPA percentage, price to adjusted book value, and credit growth, I'm pretty confident that this will outperform all insurance companies in like 1 to 2 years.
Okay.
So that's my approach.
Okay, Indian Bank. Sharmila, you don't have a view on Max Financial, but do you have a view on the insurance sector as such? Any other stock that looks good in this space, or would you stay away from the insurance space?
No, absolutely. I think that, but I think most of them are trading at fairly high valuations, so that is the other problem. And I think even when Max Financial is concerned, I think while again to just repeat what I said about ICICI Bank, I think this kind of correction that we are seeing could continue a little more. So when the stock was, I remember trading at 250, 280, that time it made a lot of sense to get into these stocks because you had all these attractive stories unfolding. But now that this whole HDFC thing has gone on the back burner, and you have the stock, as we were hearing, not getting trading at a very small discount too as a holding company, I don't really see any reason to rush in and buy.
Okay, what's the concern on Max Financial, Senthil? Is there a big concern because others don't seem to be having the trouble that Max has?
So it's not a big concern because if you see the top players, HDFC Life, SBI and ICICI, they are promoter of the bank and they have the bank assurance partners. But if you look at Max Life, they have Axis Bank as their bank assurance partner, and they also have S Bank and LVB as partners. But currently, Axis Bank is an exclusive partnership with Max. But if this partnership goes away, then Max is left with none. And we have seen like the cost plays a major role currently, and the bank assurance is the least cost of acquiring clients. So with this is a major concern, but I think the management recently mentioned like they are infusing funds to the tune of around 5,000 crores to look at inorganic opportunities. I think there are a lot of news items also, like a lot of life insurers coming on blog to buy and to get bank assurance partners. So distribution is one thing that is I see a weakness in the Max Financials. But if you look at on the other side, the strength is the product mix. Compared to ICICI and SBI, the ULIP's portion of their total product is very less. So that's one of the strength with Max Financials.
Okay, so that's the view that's coming in. Not too much of a positive view coming in from either of our guests as far as Max Financials are concerned. And the counter trading at fresh 52-week low, there seems to be some bit of concern. And the final stock that we want to talk about is Sintex Industries. Now, this counter has corrected almost 50% from the recent highs, continues to grind in even lower. So we are asking them, is it the right time to start accumulating the stock? Chokkalingam, you go first. 50% from, it's a big sale that is there. Valuation is not that expensive, but will you venture a risk into it?
I will not buy. Those who lost money, probably they can hold, because in India, low price stocks, without any reason, they flare up. They can use that kind of opportunity if it happens to come out. I'll tell you, I'll simply follow the common sense approach. Annualized revenue, sales revenue is around 2,000 crore. Even if I take a net cash and then consider net debt, net of cash, it's about 4,000 crore. Now, if you assume 10% is the interest cost, so this company has to make either 40% operating margin just to service the loan, or it has to scale up the business 4 times from here to justify this kind of debt. So, message is very clear. I would not touch this kind of company with this kind of balance sheet.
Okay, so financials having a big trouble as far as Sintex Industries is concerned. What about you, Senthil? Is it the time to accumulate, or will you also avoid?
I will also avoid, majorly because of the industry structure. Because you see, government is providing, the state government and central government both provide a interest subsidy of around 7 to 10%. So effectively, their cost of capital is just 2%. So even if they have a debt of around 4,000 crores, their cost of capital, cost of interest is just 2%. So, but on the other side, because of this interest subsidy coming in, I think every other player is putting in capacity. So we have seen SVP Global adding capacity, and these guys are putting in 6 lakh spindles in the compact ton. So a lot of capacity is coming in, and the business is a cyclical business. It depends upon the forex, it depends upon the cotton, how the cotton is going to come, and I think 65 to 70% depends upon the exports. So a lot of cyclicality is involved. Plus, the industry structure itself is not attractive. So
okay, so again, second no, and what about you? Will it be a third no?
Third no.
Okay.
Consensus for once. Well, just to take off from what both of them said, I think, I think that as we know that this was part of a larger company that had a plastic business and this yarn business. So now Sintex is left with the yarn business and you have plastics. So I prefer the plastics. I think even if you were to buy a company which had issues, etc., I think I see further growth in the plastic business, because you're talking of water tanks and molded plastics, etc. So I think that's the better stock to be in between the two. So if I had to buy between Sintex and Sintex Plastics, my money would be on Sintex Plastics.
Okay, so that's the view. I think it's a consensus no that's coming in on Sintex Industries, that is the textile and yarn company. What seems to be the other concern? Are you having any kind of promoter concern? Because that is something that the market will anticipate. Is there something on that front that you are concerned about?
So promoter qualities judged by various parameters. One parameter is the equity dilution. So last 10 years, if you see, there has been considerable amount of equity dilution based on their FCCB funds. So when the company goes for this 100% dilution kind of thing, even though when the business grows at the EPS at the bottom line level, the shareholders doesn't get anything. So I think it depends upon the business model. We have seen textiles being a very capital intensive business model. Every 5 to 7 years they have to put up additional machinery and new technology comes in. To become competitive, they have to put in this new technology and additional capex. So I think the business itself is not attractive. That's the reason they are trading at low multiples, plus also their ROEs and ROECs. So one company that stands out is Ambika Cotton. Ambika Cotton. So they are also into compact yarn, but if you look at their ROE and ROCs, it's in the upwards of 18-19%. It's a debt-free company, and they are trading at a PE of around 10 times. I think one can look at Ambika Cotton instead of other cotton compact players.
Okay, and valuations are they not attractive?
Let me just take off from what you were saying. I think that in terms of FCCB, when they were a merged company, I think ever since then, that has been taken into consideration, when market sort of valued the stock, because it was trading, it sort of did discount for the fact that they have this outstanding FCCB. So I think even when it used to trade at that 90, 100 kind of range, that was very much in the price.
Okay.
But I think yes, going forward, these will be the issues that will sort of be there for the stock, and precisely, again to take forward the same point, because this textile bit is so capital intensive. I think again plastics makes more sense.
Okay, and valuations attractive for you. I know you gave the logic why you will not it, but on the core business, they have been reducing the debt. If you see valuations at a single-digit valuations, almost 3 times next year. Is that not? Is that risk reward not in favor for someone who wants to invest?
It's a very interesting debate in the last 2-3 decades I have seen. Whether low P is a very attractive proposition or it's a dangerous one. The answer is both. Okay. So this low P itself can maybe showing some serious stress in the balance sheet. Okay. As I said, when the balance sheet comfort is not there, the low P doesn't matter at all. Okay. Because we have seen, if you look back the small cap, mid cap space in the last 20 years, wherever the companies had a huge debt on the book, 3 times, 4 times annual sales, many of them had a big problem. So I will not give importance to valuation multiple at all. Okay. When you have a 4,000 crore net debt and an annualized turnover of 2,000 crore. And also it's a mid-cap company, the promoter stake is only around 29%. Okay. And also let us not forget the fact that oil price has gone up more than 120% from 2016 bottom. That also would hit all the synthetic textile industry and plastic players indirectly. So therefore, I would not.
Okay, so I think it's a consensus no that's coming on Sintex Industries at this point of time. With that, it's a wrap on today's Hot Money. Chokkalingam, Senthil as well as Sharmila, thank you so much for joining me on the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.